Hello everyone, my name's Seymour, Company President at IBA. Thanks for joining us today. I'm joined by David Archer and Jamie Davey from the engine team at IBA. So welcome to the engine market update. We're looking across the spectrum today, though we're looking at new engine types, the older variants, and we're covering the narrow, wide and regional aircraft engine types. We've designed these sessions to consist of around 45 minutes of opinion and analysis and 15 minutes to address your questions. Thanks to those who've already submitted questions already. We'll be taking more questions during the webinar, so do please ping them over via the questions link on the control panel and we'll look to address them where we can. We have produced many of these webinars over the past few months, but we're not all in the same room at IBA, of course. There may be a brief pause in between slides, so please bear with us and be tolerant of any short delays. We do have some polling questions after slides 4, 9 and 15 today. We do have over 100 questions submitted already. Some have been addressed in the following deck, others will be followed up directly with you. I'm also pleased to announce the latest count was almost 1,100 people registered for this event today. And we fully expect 500 to be joining live, just to add a bit of pressure to David and Jamie there. Many airline delegates and obviously several hundreds from the leasing and finance community, as well as the MRO and OEM sector. So the next slide, please, Mel, where I just want to introduce IBA very briefly, a cursory run through our key pillars of support to the industry. We strive to maximize opportunities and minimize risk across aviation assets, and we do this through advisory services, engine and aircraft valuation platforms, practical asset management and technical services, as well as providing data from our awesome platform, IBA IQ. So without further ado, I'm going to pass over, next slide please, and over to David Archer. Welcome, David. Did I see David disappear then?
Sorry about that. My Wi-Fi just dropped out.
Okay.
Sorry. So to start with, I just want to start with a few high-level trends of what we've seen in the market since we're now about 6 months in now. There's a few high-level, pretty consistent trends we've seen across the market. So to begin with, looking at trading volume, obviously that's quite significantly down. And what that's largely being held back by is traders who have bought in the market high that we've seen from 2016 to 2019 and how strong that market is and how much competition there was for these assets. Obviously, there being a reluctance to sell and take that loss on their books. And at the same time, any traders that are looking to buy in the market right now, looking for some pretty significant discounts. It varies from fleet type, but we're looking at, for regional market engines, something around the region of 20% discount for a lessor to really look at that. And then as we move from narrow body to wide body, that jumps to 30% and more of a discount being required. So that's holding back any kind of real movement of assets right now. Touching on sale and leaseback activity, at the start of the lockdown, we did see a pickup in activity. That seems to have slowed down now, but we are expecting to see another pickup in the future. On the engine side, that's largely focused around newer engine materials, so LEAP 1A GTF on the A320neo and the LEAP 1B on the 737 MAX. We have seen some mixture of older assets, 7Bs and 5Bs and V25s as well being included in those deals. And for the newer engine assets, discounts remain pretty minimal, which is consistent with what we've been saying and what we've been expecting in the past. Freighter market resilience has been helpful for the mature wide-body market, particularly on the fleets around the 767, so the CF6 ATC2 or the Pratt & Whitney 4094 engines. Obviously, questions remain about how long that demand will stay, and then obviously the availability of engines coming to the market from other engines, other aircraft that those engines operate on, coming to the market for potential future teardown now that they're seeing a lot of retirements picking up. So there are some questions around that, but for now, that's been a kind of an area of positivity and a pretty poor time for the market, unfortunately. Value softening, short-term lease rate softening. This is really to be expected. This is the nature of the trading volumes that we've seen. In terms of the lease rate softening, that largely pertains to short-term lease rates or or the newest leases that we've seen anyway that have typically been shorter term. And we've seen some pretty hard negotiating tactics being put onto the lessors taking a much lower rate, much higher risk, and in some cases barely breaking even just to keep those engines in service. And finally, deferrals. So this is now approaching the second wave, if not well into the second wave of deferrals of operators with the lessors, and what that means to them. Obviously, reduced cash flows. We've seen a lot of activity around trying to make a win-win situation for the airlines and the lessors. In some cases, we've even seen engines being provided to the lessor as a way of payment in lieu of the debt they owe to wipe the slate clean. So the results, obviously, small trading volumes, newer engines seeing very minimal discounts. As you're seeing more and more mature assets, some pretty steep discounts being seen in the market. These heavier discounts that should be mentioned as well. These are what we would classify as distressed transactions. These don't reflect our view of the market value, but any sale going through right now, whoever's selling is going to be having their hand largely forced, and whoever's purchasing is going to want to minimize the risk that they're taking on in a soft market. Short-term lease rates, as mentioned, already down. Lease rate factors actually picking up in some cases. This is largely around the newest generation of engines, where we're seeing slight discounts on these new generation engines compared to the high levels of competition to purchase them barely a year ago. And then finally, the shop visit demand collapse, which we'll touch on again later. This is kind of a major area of debate around the market, but we've seen so far in Q2 revenue dropping around 50% or more, being a fairly consistent feedback there. But we'll touch on that in a moment. If we can go on to the next slide, please. So how is the market reacting? I'm going to look here at three of the key areas in the engine market. So engine lessors, the MROs, and the OEMs. A pretty consistent trend across all of them. It's the first point for each is the focus on cost cutting. So obviously all of them are taking this as a very key area of concern, reducing overhead, making themselves, at least in some way, less cash negative at the very least. For lessors, what that has meant is, as mentioned, deferrals where possible. These are obviously negotiated on a case-by-case basis, depending on the client, but that has been ongoing. We're seeing an increase in the requirement of PBH agreements and also mechanical leases, which are putting the risk of the asset and any failure on the asset back onto the lessor, and obviously the rates barely breaking even for the lessor. So a lot of pressure on them on that side of things. They're also seeing an increased number of engines being returned off lease. Now, only a small number of these are actually related to bankruptcies, particularly any that are related to COVID. It's only a small number. So a lot of them were forecast to be returned. The difference is they were also projected to be putting back on lease at some point, and that's been the struggle so far. The focus of most lessors right now is going to be around sale and leaseback deals, around the newer engines, lower risk, a bit of a more attractive asset, and one that we are a lot more confident in the value performance of. And again, that issue, as mentioned before, the price point that they would need to make these deals work for them, pretty significant discounts, and very few people are willing to let go of their engines at that rate. We do expect to see kind of a bit of a pickup in the near future. Obviously, winter is going to be a bit of a rough time, and we expect to see airlines looking to shed off some more assets, whether it's through sale and leasebacks or otherwise, and we expect to see probably discounts in that range, as these will be distressed sales. If we look at the MRO market, again, the focus is on cost cutting. So whether it's through redundancy or just reducing the capacity overall to try and match capacity with demand, that's a very difficult thing to do right now, as well as trying to project how the recovery is going to play out. We touch on that again later, but very difficult activity for the MROs right now. I've noted here, surprisingly, still seeing some delays in slots. Now, overall, the trend is very minimal lead time for slots across all engine types, really. But we have, in some cases, heard of delays, and that seems to be largely down to light scope kind of hospital shop visits on these engines, not the full work scope overhaul and LLP replacements. And we're also seeing, obviously, an uptick in lease returns and the inspections and the works required there. But that has been the shift there. Again, as mentioned, capacity reduction, looking at 50 to 60% revenue drop in Q2. Q3 is typically the season when we see a lot of MRO activity. So there's questions around how we'll see that perform. likely going to be seeing a bit more of a drop from there before hopefully a recovery through spring next year. And then the knock-on effect of all of that in terms of teardown activity and appetite for used serviceable material in the aftermarket. Obviously, that's usually a great way to save on the expense of a shop visit. But with the low utilization and the low level of consumption of this material, as airlines are looking to avoid shop visits wherever possible, and if they can put an engine that is serviceable on wing rather than putting that engine through the shop, we're seeing a pretty strong reduction in the value of components, whether it's engine related or aircraft related in the aftermarket. Finally, onto the OEMs, again, cost cutting. I'm sure everyone's seen the headlines around those. Production output is coming down as has to be done, and that is putting some pressure on their supply chain networks, and that's a bit of an area of concern longer term, and how they will ramp that back up in the future. Again, negotiating with their customers on minimums where possible, on a case-by-case basis, and most of the OEMs are doing this. Then in terms of the entry to service issues that we've seen, if we move to the next slide, I've just provided an overview of the issues surrounding, sorry, if we can move to the next slide. There you go. I've just provided a pretty detailed slide here. I won't go through all the points, but the overall consensus is that the OEMs are using this time to be as productive as they possibly can be. They're using this time to mitigate issues that have been problems so far. CFM has worked well to put in place fixes or investigate root causes. And it looks like through 2020, 2021, we'll see a lot of those being resolved on those fleets. The GTF, a lot of corrective actions in place. The list there, all of those have some corrective action in place right now. And with the new combustor coming out sometime soon in 2020, a positive outlook there for the future of the fleet. Obviously, that will need to be implemented across the fleet, but given the grounding activity, hopefully that's something that can be done with much less disruption to the operators. And finally, on the Trent 1000, obviously an engine's had a lot of conversation around it. Rolls-Royce reporting that they're now down to 0 AOG events, which is obviously quite positive news there. Obviously you can read through this later, but the takeaway is quite positive in terms of what the owners have been doing. If we can move to the next slide, please. Before I go into these, we provided these slides before, and I want to touch on a key point that these are not perfect comparisons. So what we're looking at here is the CFM56-3C, so that's the engine on the 737 Classic, and how that performed through its life, and then a comparison of two V2500 variants. Now, these are looking at mostly the focus on the impact of September the 11th and SARS, but comparing COVID to that, it's on a whole different scale. So I understand the argument that these aren't a perfect comparison. However, the trends will be the same. The scale of the drop and how long we take to see the recovery, that will be the difference. But overall, the trends should be the same. Now, we've touched on these before, but just to highlight on the CFM56-3C there on the left, if we look at the value performance of the green line, which is the lease rate, the red line, which is the market value, and the blue line, which is the base value. So early in life, early 1990s, you're looking at issues around the Gulf War, and you're seeing a lot of value resilience there. You do see lease rates soften, but the market value holds very close to base. And that's expectation-wise, that's what we're seeing and what we expect to see from the LEAPs and the GTF engines, and also the newer widebody engines, Trent XWB or Gen X1B, those kind of engines. As we move to September the 11th, on the -3 there, we are looking at a more mature asset. A good comparison here would be the 7Bs, 5Bs, and V25s of the world, and how they reacted then. Now, the base value was projected. We expected to see a drop, but the market value dropping below base, that's the reaction of the market. And we expect to see that now. We should see the market value pull below base, and then as we move to the future, see that recovery again. Again, whether we'll recover to 2019 levels, I think that's quite debatable. But returning to base value is what we expect, and we don't see any reason to change our base value outlook for these engines. If we look at the slide on the right, all I want to bring from that really is just a comparison of generations of an engine. So what variant you're looking at. In this case, we're looking at an A1 and an A5, so an early build standard, the V25, and a later build standard, and how those perform differently. And also you can draw some comparison there about different generations and maturities of engines. So the difference really is that the level of value dropping and what percentage-wise that was much steeper on the A1 compared to the newer A5, and the recovery period was much slower. And again, this is what we've looked at and what we've talked about with these more mature narrow body and particularly wide body engines. If we can move on to the next slide, please. So briefly touching here just on the outlook of the order book and what that means for the market. Really, the takeaway here is a big shift towards narrow body engines. The order book largely focused around the Neo and the 737 MAX. Unsurprising there. There are some strong order books there for wide body engines and wide body aircraft, but the narrow body engine takes the lion's share of the market. Cancellations, I think it's an important area to touch on. Even ignoring the MAX, there's a significant number of cancellations within that fleet. But the MAX is by far and away the leader there. In terms of whether that affects our view of the value, not really. Now, we have taken a softer view of the LEAP 1B, but again, as mentioned, these newer engines, we're expecting quite a bit of resilience in the value. So we're not expecting a pretty significant change from that. Long term, what a longer production life and a bigger backlog can mean is perhaps a longer tail end of life for the fleet, but there's a significant order book still there to be fulfilled. And we're quite optimistic that some of these cancellations we'll see orders replacing them in the future. So we haven't changed our outlook for the engine, perhaps slightly less positive than the Neo fleet, but really that's about it on the engine side. And then on the backlog, really just reaffirming what we've seen in the last few years, that shift to a narrow body focus. You can see just how much the backlog is focused in that area, particularly when compared to the current in-service fleets of those aircraft types. I think that's an important takeaway in terms of the future and the confidence we have in that narrow body fleet. If we can move to the next slide, please. Again, a slide that we've shown before, but we've made a slight tweak on how we're showing our outlook. The slide on the left is showing pre-COVID our view of the number of shop visits we were forecasting. We've broken it out by narrow body, regional, and wide body. And the trend there was really very strong growth across, the whole aftermarket, the MRO market in particular, very strong growth. The fleet was growing, utilization was increasing year on year, and we were seeing a lot of demand for shop visits. That has obviously changed pretty significantly, but that demand should still be there in some cases. So if we move to this right chart, we're instead looking here at, as a percentage of these shop visits, how many were first run engines or will be first run engines, second run, and more mature. Now, in terms of vulnerability to not going back into the shop, the most vulnerable will be a mature wide body engine, whereas a first run narrow body engine is going to be most likely be put back into the shop. It's a good investment. So clearly the Leaps and the GTS are examples of these, but also the CFM56 family, over 50% of those engines have yet to go through their first shop run. So there is a lot of confidence that some of this demand will be coming back. But vulnerability is around that top segment of wide body shop visits that we predicted and the top segment of mature shop visits that we're expecting. If we move to the next slide, we can show kind of how we're looking at this now. So that's the line at the back shows the total shop visits from that previous slide of narrow body, wide body, and regional jet shop visits that we expected. I put in there a dotted line just so you can see what 2020 levels were expected to be and when we think we could recover to those levels. We've provided 3 scenarios, becoming more and more pessimistic of our outlook, and how we've arrived at those is firstly looking at how severe the MRO demand drop is going to be. A lot of debate around that. As I say, revenue drops 50 to 60% is concerning, and then there's a question around of the shop visits that we are going to see, how many will be those full overhaul and LLP replacement shop visits that we're reflecting here. So how severe will that drop be? That's the first area to look at. The next will be how long till the recovery in demand. So this is when will utilization pick up, and when will we start to see the point that airlines and lessors and operators will start to look to put their engines back into the shop. After that, we're looking at capacity recovery, and this is with the MROs trying to match capacity demand right now. If that potentially jumps up, how will they recover to that? Will there be delays to meeting that capacity demand, and we'll start seeing those long slot lead times that we saw previously in recent years? And finally, of these offset shop visits that we're not going to see today, how many of them are going to come to fruition? And that's a big question. And as I mentioned on that last slide, we're looking there at how mature is the asset, what's the aircraft classification, is it a narrow body or wide body? And that will have a key role in whether these shop visits do come to fruition. So we should see a shift towards more of the short to mid-term shop visits being narrow body and newer engines in percentage terms, and that's our expectation. If we can move, I think we have a question off this one, don't we, Phil?
Yeah. Well, we missed the one after slide 4, so we might go back to that at some point if we have time. This is a bit technical. Apologies for those of you who may not know what a PMA part or a DER repair is, but I know a lot of you will know. These are basically the alternative but fully certified parts which some airlines like to use to reduce the cost of shop visits, and the DER repairs are locally designated engineering representative repairs rather than going through the OEM. So I think looking at on the back of sort of the MRO shop visit, the whole need to preserve cash is a very simple question for you to consider. Do you expect to see a rise in PMA parts and DER repairs in the next 3 years? So we'll give you a few seconds to toss a coin and decide whether it's yes or no. But this does come into, this does bring up the whole area of shop visit management, and we're going to be looking at a separate webinar on that in the coming weeks. So, well, it does look like there is almost a heads or tails decision here. I suspect a lot of lessors or financiers possibly don't want to see a rise in their use, but a very small margin in favour of, yes, there could be an increase in the use of PMA parts and DER repairs. So thanks for that. I'll hand back to you, David, to progress through to the rest of the presentation.
Sure. If we can move to the next slide, I think I'm handing over to Jamie now. So Jamie, take it away.
Thank you very much. So let's start with the narrow body fleet trends. So these two charts here are showing the performance of the engines during COVID-19. So on the left, you can see it's the active engines. On the right is the parked and stored engines. Now, parking does mean engines have been on the ground for 14 days or less. If we look at the CFM 7B, for example, which is the light blue line, you can see that they've had the highest impact, mainly due to the large populations of these engines. But you see that a large number of these engines have gone into storage. If you compare the number of engines that are active in January 2020 to the number of engines that were parked and stored in April 2020, 54% of the active engines ended up in storage for the 7B. Now, if you combine the two A320 current engine option engines, so the V2500s and the 5Bs, and compare them again from January, so active in January over to parked in April, it was a 69% reduction in active fleet. The A320neo engines, so for the LEAP 1A and the Pratt & Whitney GTFs, on the graph here, it does look like it hasn't had that much of an impact, but bear in mind that there's actually a lower population of these engines, especially as they're still emerging in the market at the moment. And in terms of comparing them again from January until April, there was a 58% reduction in active engines between January and April. So there are signs of recovery, and as you can see already, the narrow body market is beginning to recover quite nicely, but still not up to pre-COVID levels. One big question, though, is what will happen in winter this year, especially as the pre-COVID numbers that I've got here in front of you are for the winter schedules. What's to say that winter this year might be a bit tough? I think it's the best way to put it. If we move over to the next slide. Thank you. So on here, I've shown the annual events for the past 10 years for the engines. So it's worth noting before I get into this one that the data on the right-hand side is exactly the same as the data on the left-hand side. It's just obviously the left hasn't fully put 2020 in yet, but we'll get there. So before COVID, we did notice a bit of correlation. So if you see the thick blue line, that shows the Brent oil price within the past 10 years. We noticed a correlation between the oil price and the number of engines that remained in service. So the one thing that we noticed that when the Brent oil price was high, we noticed a lot more retirements or more engines going into storage, mainly more mature engine types going into storage. Mainly as operators would see that these engines were more expensive to operate, especially if they weren't that fuel efficient. It seems it's not very sustainable to keep an older engine running when it costs more to fuel the thing. But then when the Brent fuel price begins to soften, as you can see in 2016, there were more engines that were starting to re-enter service, especially if they came out of storage. And a lot of these engines went into green time, so meaning that operators will try and use these will try and keep these engines going as long as possible. Even though they might not be fully fuel efficient, they still found it quite beneficial to keep them going whilst waiting for newer technologies to come in. And as you see on the right, what I've been saying there doesn't apply anymore. So you can see that COVID-19 has almost changed the rules there, and airlines and lessors are really trying to find ways to cut the costs and try and remain profitable during this period of uncertainty. So if we can move to the next slide. So if we talk about the current generation of narrow bodies, there's no mistake that the short-haul market will be one of the first markets to recover, and there are already positive signs that there are recovery right now. And you can see that there are many engines that are now coming back into service, especially in North America, in Europe, and Asia. But even though that these flights are increasing and these engines are flying more, that doesn't necessarily mean that their load factors are going to be high at all. Because bear in mind that there's still border restrictions all across these regions. So many passengers might not be confident in traveling just yet. So if we look at the value movements, it's mainly the mature engine types, as we've discussed before, that are going to be seeing the highest movements in value. The base values, sorry, the base engine models for the CFM 7B26 and the 5B are seeing the highest swings in the value change, mainly as the host aircraft types nowadays they've reached the end of their production cycle, and since these original engines have come into production, there are now tech insertions and performance improvement programs that are now attached to these engines. So these newer engines are considered the current technologies. So it does mean that there's a bit more of a risk for these for the more mature examples of these narrow body engines. Airlines nowadays are going through a phase of fleet consolidation, especially to match the demand of the current market. So this could result in parting out activity and more retirements as time goes on, which is also causing now a bit more of an oversupply of engines in that field, especially when it comes to spare parts. Before COVID-19, we were seeing that the spare parts were in quite high demand, but as the demand for air transport is not fully there will now be more spares coming into the market later on down the line. And just to touch briefly before I move on, in terms of the regions, as you can see that there's already been some recovery. Just a little fun fact for you. In terms of Asia Pacific, the current number of engines in service, so that's all the narrow bodies, all the current generation narrow bodies. In Asia, there are 10,426 engines currently in service. 5,374 of those engines originate from China, so that's 48% of the engines coming out of the Asia Pacific region are from China. So it does show that the Chinese government are really trying to jumpstart their air transport markets and also their economy as well. If we move over to the next slide. So then we get on to the new generation narrow bodies. So the new generation narrow bodies have been quite resilient throughout the pandemic, and they have performed quite vital roles. So they've been in charge of transporting medical equipment and repatriating passengers home. Quite a fun thing that's happened during the pandemic is Wizz Air. They were sending their Airbus A321neos over to the United States, so many spotters saw them in LAX and also in JFK. and you also spotted them in China as well, repatriating passengers and transporting medical equipment. And as David has said, that yes, there has been a softening of these values, but again, we do expect that these engine values will recover in the coming years. Well, obviously, we have had to be a little bit harsher on the 737 MAX, but again, once the aircraft comes into service, and we are confident that that aircraft will come into service, then we should expect that it should pick up quite nicely. If we look at the order books and the orders and cancellations, new orders are beginning to slow now for the A320neo. So that's for the LEAP 1A and the Pratt & Whitney GTF engine. But their backlogs are still very significant, with a very large number of operators across the world. But obviously, it's the LEAP 1B that has seen the highest number of cancellations, and that is due to the uncertainty of the 737 MAX, of when that aircraft will come back into service. It's almost the white elephant in the room there, really. So in terms of the 737 MAX cancellations, this year we're seeing a lot more lessors cancelling the engines. But we also saw Norwegian, as one of the biggest customers of the 737 MAX, cancel their orders. And obviously Norwegian were quite vocal when the MAX was grounded, because they'd already implemented the aircraft into their schedules and into their fleet. So obviously they've had quite a large impact from them. So it's one of those things. If we'd like to move on to the next slide. So now we move on to the wide body. Now, I couldn't fit all the engines in there, otherwise the graphs will be quite small and you might need a pair of binoculars. So the long haul markets will always take longer to recover, especially as there's issues with borders at the moment. If you look at one of the busiest long haul routes out there, London to New York, currently at the moment, the Brits still can't enter the United States, and I'm sure it's the same the other side at the moment. So it will take longer to recover, but again, there are still signs of a slow recovery at the moment. But you can see the winners and losers quite clearly here. I mean, the Airbus A380, for example, 99% of their fleets were grounded during the pandemic. And in terms of the Airbus A330 current engine option, 68% of that fleet was grounded during the pandemic. But it's the newer generation engines, the Gen X's, the Trent 1000s, and the XWBs for the 787s and A350s. These are the engines that are almost bouncing back quite slowly, but they're on their way back, and they have almost been the workhorses during the pandemic. There have been examples of airlines who have been converting their passenger aircraft to take advantage of the revenue opportunities from cargo operations during this time of uncertainty. And if we move over to the next slide. So when it comes to the wide bodies, before COVID-19, the wide body operators were already in the process of replacing their older fleets. So it meant that there was already a surplus of engines entering the secondary markets at the moment. COVID-19 has only accelerated these retirement programs. So for example, British Airways did have a program set up to start retiring their 747 fleet, but obviously COVID-19 has now meant that the 747s are pretty much retired and off to Kemble. So it does mean that the mature engines are at the greatest risk at the moment, and obviously they are showing some of the more higher market value swings there. For example, the Airbus A330 current engine option, you're seeing a 21%, 21% for their older engine types, and the Trent 700s, which has, I believe, the higher population on that one, is showing 18%. But obviously, one of the big losers is the Airbus A380, which has seen quite a significant shift in that market value. the main reason is that airlines are trying to stay profitable at the moment, and I think everyone's starting to realise that the A380 really is an expensive aircraft to operate. It does require quite significant infrastructure as well to support that aircraft. So you are seeing operators who are deciding we need to stay profitable, so we just need to get rid of the aircraft type. But the GP7200 engine, the Engine Alliance, that one has a lower value swing than the Trent 900. Even though that there's no backlog for the engine anymore, it still has a good operator base. Mainly it's Emirates with the largest fleets there, so there will still be some need for those engines. But it's the Trent 900s that still have an order book, still have a backlog, 9 aircraft in total, 8 for Emirates and 1 for all Nippon Airways. So this is the part where I'm going to pass back to Phil for our poll question.
Yeah, thanks, Jamie. Yeah, well, this leads very nicely into the next poll question. I think this could be a leading question given what Jamie's just described. So given this point that Jamie mentioned about the remaining orders for the Trent 900 engines for the A380, do you think the remaining Trent 900 orders for the A380 will be fulfilled? A simple question again, yes or no. So let's see how that one comes up. We'll give you a few more seconds and we'll await the response on that. Yeah, well, I think I don't know, possibly 17% of the respondents work for Rolls-Royce, perhaps, but clearly a large majority thinking that they're going to struggle to fulfill those orders. And I suppose we're waiting to see how Emirates treat the A380. Obviously, it's got so many, it won't be storing all of those, but it's going to have a serious rethink about the mix between the other options it has with other wide bodies. So thanks for taking part in that response, and back to the main deck.
Thank you. So if we move over now to the regional and turboprop engine trends, I won't spend overly too long on this graph here. The main thing to take away from this one is that there is some solid performance coming from this particular sector, despite the significant reductions in the active engines. There are signs, a bit like with the narrow body market, there are signs of a steady recovery for these engine types. If we move over to the next slide. So if we look at the updates here, I think the main takeaway from this one is that with regional engines and turboprops, there is always still going to be a place for these engines, especially when it comes to turboprops. Turboprops serve very, very harsh regions of the world, very remote parts of the world, and there's always a need for air connectivity from these regions. So turboprops will always still have their place, and also regionals are still continuing on. Despite this, there have been a number of high-profile failures recently. Flybe happened just before COVID, which has obviously caused a little bit of a surplus in engines entering the market. And you are starting to notice, especially from the big American carriers, accelerated retirements of the CRJs, so the CF34 8C5s, and the ERJs, which is the AE 3007s. Again, as I've stated before, that these airlines were already starting a retirement program for these aircraft types, but obviously COVID has really just accelerated the retirement process here. And mainly the values that you're seeing are driven by these external market conditions, and it's the Embraer E-jets at the moment which are remaining quite consistent at the moment at 5% value change. These are the current technology at the moment for the regional jets, and we should anticipate that these will make a recovery. But obviously the turboprops will always encounter a bit more volatility in the market, especially as operators come and go, really. But there is still going to be a need for these engines, as I've stated, thus showing why that there's a bit of a smaller market change on that one. And if we move over to the next slide, that will be all from me.
Right, thank you, Jamie. So just to summarise key takeaways. In the short term, we've come out of, unfortunately, what was a failed recovery through to the summer. We're leading into a pretty dire looking winter. So short term, quite a negative outlook in terms of what we're going to see in terms of value performance. Whether we see further softening is to be seen, but for now, it's not a positive short term outlook. We are now entering the MRO season. As mentioned, revenues quite significantly down. We've heard reductions of requirements between 30 and 70%, so it varies a lot from fleet to fleet. And the question, of course, will then also be around what kind of scope of these shop visits will we see? If there is, some recovery in the count, will they be of a lower scope that we've seen recently in lease returns and kind of hospital visits, light work scope shop visits? And obviously now we're in that second round of deferrals, putting more pressure on the lessors. Trying to find that win-win scenario between the airline and the lessors is very difficult. In the midterm, hopefully start to see some more sale and leaseback activity with that improving lease rate factor as a healthy outlook for the future of the market at the very least. There are concerns around re-entry to service. We had these same concerns around the 737 MAX, around how long they've been parked for and whether that would cause logistical issues going forwards. And now we're looking at that for a large proportion of the entire global fleet. An incident that I suppose could reflect this is with BA's 777s powered by the GE90, and there were reports recently of some issues with the oil systems, potentially from how they were stored. Now, if that may reflect what we see in the rest of the market, that may not, but just an interesting case study there, and with a potential SB or AD to come for that fleet. Long term, that question around returning to normal levels, I think it's very debatable if what we had in the last few years is normal. We all knew a correction was due. This is a cyclical market. I think what we're seeing is more than a correction, is much more than a correction. So we do expect a recovery long term, but whether we return to those 2019 levels, I think that's debatable. IATA, just referring to their latest figures, 2019 utilization levels not expected until 2024. Just to give you an idea of how long this delay in recovery could take. And then just to summarize on aircraft classes, narrow body fleet, we're quite optimistic on. Obviously, the more mature examples are going to see a bit more of an impact, but the latest generation, really, we're quite confident there. Regional market, again, I mean, obviously there has been a softening there, but in comparison, if we were to compare lessor to lessor from the regional to the narrow body space, just slightly more optimistic. And then the wide body market, there has been support from the freighter market. We'll see how long that goes on for. Latest generation engines, we're optimistic on. It's those in between mature wide body engines that haven't got support at the moment. That's where the concern lies around the recovery. And that's it from me today. I guess we'll turn now to questions.
Yeah, thanks, Jamie and David. We've had a number of questions, some of them quite specific, about some shop visit forecasts of specific engines, but I think we'll come back to you individually on those. Coming back to this, the PMA and DER question, we've had a question about whether if there's going to be an oversupply of used material, then would this reduce the need for PMA and DER input? So I suppose here it's a view that if we're going to see more engines parted out, because I know perhaps lessors don't see a robust leasing model for a particular type of engine, will those engines be torn down? And will that mean that the PMA DER market correspondingly doesn't have as much demand? Have you got any views on that, David?
Sure. I mean, I think there's an interesting discussion around that. I think if PMAs and DERs were ever going to pick up, now is the time with airlines looking to cut costs. But I think you're absolutely right. We're going to see huge surplus in engines and material in the midterm future at least, and whether or not that does stifle demand. I guess it's the comparison of, would an airline prefer or an operator prefer a new PMA to a used OEM part? I guess that could be an interesting question around that, but I guess it's to be seen what the appetite is going to be like. Really, it's a difficult one. I think the question is really around, does it affect residual values? And that's the biggest concern. And the parties that are most worried about that, I doubt they're going to change their mind too soon, particularly in the gas path of an engine.
Yeah, actually corresponding to that situation, a question we've had is, will we see OEM discounting on new parts, which will then obviously be the other side of the equation. As an airline, maybe you're going to be spoilt for choice. Maybe you're going to see discounts on OEM parts, you're going to have used material at discount, and you're going to have PMA options. So perhaps the market is the market at the end of the day. So perhaps the airlines will benefit whichever course they take.
I mean, I did actually reach out to some of the OEMs about this quite recently. I mean, the feedback so far is no, that's not the case. We're not seeing that. We are seeing negotiations on power by the hour contracts. But in terms of, sorry, can you repeat the question? I've just gone down the wrong path.
Sorry, I'm already reading the next one. I was talking about whether airlines will have so much choice that they'll have OEM parts at discount prices because OEMs themselves have got to look at their own business models. So it's really I'd say maybe it's too early to say it's a win-win situation for airlines, but ultimately the market will speak, and if demand is dropping for parts and supplies increasing, whether it's new or PMA parts, it's inevitable that will happen. So actually, David, maybe it's not a question. I've kind of summarized that up in the question. I think an area, and Jamie, I think even within IBA, we've gone round in circles on this amongst the some of the guys who've been in the industry for decades, and almost then looking at, well, what is the data saying? What is IBA IQ saying about utilization and values and lease rates? That regional market, I think we get a lot of questions around, well, the regional market is going to be more robust because it is dealing with domestic markets. Domestic markets are less impacted by government barriers or corridors. But I suppose the evidence is that the airlines with regional equipment, still a lot are being parked. You mentioned Flybe, and of course some of the lessors who specialise in that sector are amongst the biggest fleets that are grounded. So I suppose I'm struggling to see whether the theory of there'll be more short haul flying, whether that is being played out. But do you see any improvement in that, or is it really just down to a decision on, well, older equipment is going to be parked, and if that happens to be a turboprop, it's going to be parked? Have you got any sort of views on how that might play out?
I think personally it more depends on the market, really, because I think if you've got a regional aircraft or a domestic aircraft that are providing essential air links between communities, I think that is what will remain quite stable, because if you think of regions, for example, in northern Canada, or if you go out into South America, or even areas of the Asia Pacific, these regional aircraft will provide the essential connectivity needed, so there will always be a need, because if you take away those aircraft, those regions are pretty much cut off from the rest of the world. But I think it's more those regions who are just using turboprop aircraft to do very short hops. For example, if you're going from London to Exeter, then obviously that might be where the demand isn't fully there just yet. But I think if it is essential enough, I think it will. I think that there will be recovery in that one. It's just keeping essential links open instead of just adding to everything at the moment.
Yeah, this also sort of brings up the subject of the environment, though, because we've seen some governments, even airlines. I think it was KLM basically saying if you're going to do a short journey, take the train. I know that was a pre-COVID message, but the environmental issues are here to stay. I mean, I think perhaps they went on the in the back of the mind of airlines when you're in your fight for survival. But in terms of shop visit projections, David, do you think any of those? I think one of the graphs we showed was sort of shop visit number 3 is still going to be a huge part of the market going forward. And I imagine, I mean, correct me if I'm wrong, but if you're talking about an average shop visit 1, maybe I know 8,000 cycles, and shop visit 2 at 6,000 cycles, and after that, and then reducing. Is there a chance that those shop visit 3s may not happen because there's going to be a drive towards replacing older aircraft with newer technology?
I mean, I'm sure there'll be some incentives around that. I mean, to start off with, on the shop visit forecast, absolutely. So it's those mature examples. Those are going to be the ones where there's the biggest questions. Should we invest further in this asset? Some of them have pretty substantial cost of overhaul, which is a big question there. But in terms of whether that's going to shift towards an environmental focus, I think the financials will be the key driver, but it could be a bit of a kickstart or a jump start in the direction of improving that. And you're right. I mean, once COVID, fingers crossed, transitions to a thing of the past, environmental issues will come back to the forefront. And maybe this is a chance. I know some of the governments are supporting it as well, to transition to a greener fleet, quote unquote. But obviously the questions around technology advancing, that's still a big question. But to a newer, more efficient fleet, absolutely, I think this could be a bit of a transition point.
Yeah. I'm going to come back to PMA and DER repairs because we're getting quite a few questions on it. It is the gift that keeps on giving in terms of industry chat. And of course, the point being made through this question, or maybe it's a statement, which is, 99 out of 100 operating leases prohibit PMA and DER use, particularly in the gas path. So if you're trying to run a fleet of aircraft as an airline, you've got a leased fleet perhaps and an owned fleet. Your shop visit program tends to be standardized. You don't tend to separate an engine management program based on whether you lease it or own it. So, really, is it really an option? I do want to pick up that myself. I'm not putting you on the spot, David or Jamie, really, because I suppose this brings up, again, I've mentioned the webinar we're going to be doing on engine shop visit management, because I think, yes, operating leases, they're contractual. They are, you can take somebody to court and say this is what the contract said. But I actually wonder whether the industry needs to rethink, and if there's ways of helping airlines preserve cash, then perhaps there should be a review of some of these rather almost straitjacket clauses in some of the leases which do prohibit that. Maybe now is the time when you've got to sit down and say, look, we've got this specific engine, there's this specific build program we want to put into place, and we think that there may be a time and place for PMA parts and DER repairs. And that also leads into the whole operating lease at the aircraft level. The definitions for a claim against maintenance reserves are usually fairly tight. They need to be perhaps a full work scope. All modules need to be at a particular high level or overhaul level according to the engine work scope guide. I just wonder if there is a time when you've got to sit down with the lessor and say, look, I know it says I've got to build this engine for 8,000 cycles, but actually, I'm not sure how long 8,000 cycles is in a post-COVID world, because we haven't figured out the fleet program. So can we do a short build? Can we build for 3,000 cycles? It'll be a lower shop visit. yes, it won't stay on the wing for as long as an 8,000 cycle engine, but we need to preserve cash. Is that too contentious, David? Do you think the IBA hotline will be buzzing from lessors, annoyed that we're even putting those thoughts into the minds of airlines out there?
Probably, just because there's going to be the concerns around the impact on the residual value. But in terms of the implementation of PMA and DERs, I guess we'll see. I mean, now you're absolutely right that the leases are kind of a difficult conversation point right now, and a lot is being done to try and find those win-win scenarios. Anyone involved now putting through a new lease, and if we're talking about this material, we're talking about engines that aren't on these flight hour agreements with the OEMs. We're talking about typically more mature engines. I think you're in a position of power in that negotiation. If you're going to be leasing a used engine, maybe we'll start seeing a transition towards that in the future. It's definitely going to be a point of conversation, I'm sure, across some negotiations.
Yeah, well, dare I say that I think even the OEMs who've got engines on long-term programs, without naming names, if they've been collecting reserves towards the next shop visit, I mean, surely it will be in their mind as well, won't it, to actually not necessarily gold plate that engine that stays on wing for 8,000 cycles, but actually, look at things a little bit more short term and say, look, this is a work scope. It's going to keep the engine going for 3,000 cycles. You can get it back in 50 days instead of 110 days. Yeah, I think even the OEMs will start looking at the work scopes that they're going to put into some of these engine builds. Also associated with that, I mean, we've spent a lot of time talking about utilization and whether the utilization will get back to 2019 levels, but also what we're seeing is a change of use. I mean, Jamie, you were talking about how although the A321 XLR is defined as being extra long range, it's probably been flying to much longer sectors than even the likes of Wizz envisaged. And also we're seeing some of these so-called freighters that you mentioned, conversions of some aircraft into a freighter type configuration. That will impact the hour to cycle ratio. And there's a lot of leases which actually define what, the maintenance reserves are set based on a specific hour to cycle ratio. Again, that's going to be thrown up in the air, isn't it, David? We're going to be doing a lot of our fly forward calculations. They're going to have to be recalculated because airlines are flying their aircraft and engines in a different way.
Absolutely, and I mean that's a big part of our shop visit forecast. We've produced year on year for some time now, and there's a reason why we're not providing a de facto this is our projection of the forecast, because there's so many variables at play right now. And absolutely, I think change of use of aircraft is going to be a pretty major factor. Along with, we, like you said before, we've already seen a change in limiting work scopes on engines as it stands, and we'll see how that continues into the future. I think the short building idea is absolutely something that could pick up speed. Yeah.
And we've had a question around our engine values and how often we update those. Can you just clarify that?
Sure. We try and update them as regularly as we can. We review them, on a weekly and monthly basis. We used to provide our engine values book once a year. Now we have our IQ engine values. We update that as and when we change any valuation for any asset. So we did a very recent update with the latest update to our view of COVID values. And I would expect one or two more updates to come up, before Christmas for sure, as we get more and more information.
Okay. Well, look, thanks for that. We're almost coming up to the hour. We do have, there's been a lot of questions that we haven't fully addressed here. Some of them are actually quite specific, but we will get back to each and every one of you there. So I'm actually going to run through our exit slide now. So just to say thanks very much. The data you've seen today is from our online data intelligence platform, IBA IQ. We are offering demonstrations. There's a strong demand, so I would get in quick if you need a demonstration. Do drop us a line or register through the website if you want to take a look at that. So please get in touch if there's anything else we've discussed today that you think you need some support on. Thank you everyone for attending today's session. You will receive a follow-up email tomorrow with a link to view a recording of today's session and of course the slide deck. So on behalf of IBA, David, Jamie, and the marketing team of Mel, Lucy, Dom and Abby, who've organised us to produce this event, I just say goodbye. Thank you.
Very much.